Initial public offer, eligibility criteria. Thinking of taking your company public? Before you start, let's break down the strict eligibility criteria under Part A of Chapter 3 in the IFSCA Listing Regulations 2024 for companies aiming to conduct an initial public offering. These criteria ensure only financially stable and operationally sound companies can raise capital through public offerings. Here is what your company needs to meet for an IPO. 1. Operating revenue or profit requirement. Operating revenue of at least $20 million in the last financial year or averaged over the last 3 years. Alternatively, a pre-tax profit of $1 million in the last financial year or averaged over the 3 years. 2. Market capitalization. Post-issue market capitalization of at least $25 million. Other criteria. The issuer may also qualify under any other eligibility criteria specified by the IFSCA. And remember, the financial year refers to the one followed by the issuer according to home jurisdiction laws, providing flexibility for global operations. Special rights equity shares and offer for sale regulations. What if your company has special rights equity shares, SR equity shares? There are some extra conditions before you can proceed with an IPO. Here is what you need to know. The issuance of SR equity shares must be authorized by a shareholders' resolution passed at a general meeting. These SR equity shares must have been held for at least 3 months before filing the draft offer document. In addition to SR shares, the IFSCA regulations specify conditions for offer for sale. These are: 1. The securities offered must have been held by existing shareholders for at least 1 year before filing. 2. The combined holding period of convertible securities and equity shares will count towards this 1 year requirement. However, there are some exceptions. Shares acquired from a merger or amalgamation that's been in existence for at least 1 year. Bonus issues from the free reserves held for at least 1 year. This ensures investors are protected from acquiring newly issued shares without sufficient operational history. Appointment of lead manager and stock exchange approvals. Ready to move forward? Your next step is appointing a lead manager to manage the entire process, including submitting offer documents. It's also essential to apply for in-principle approval from a recognized stock exchange before listing. If you are applying to multiple exchanges, make sure you select one as the designated stock exchange. The stock exchange will grant approval or reject the application within 15 days from the receipt of a complete application. Filing the offer document and disclosures. Now, let's focus on the offer document, one of the most critical steps in the IPO or FPO process. The requirements differ based on the size of the issue. Here is what you need to know. For issues under $50 million, here are the steps. 1. File a draft offer document along with the applicable fees to the IFSCA. 2. Submit a due diligence certificate. 3. The document will be hosted on multiple platforms for transparency. For issues over $50 million, similar draft offer document and due diligence procedures apply. The draft must remain online for 7 working days to invite public comments. The IFSCA issues observation within 21 working days. After incorporating amendments, submit the updated offer document to proceed. This process ensures full transparency and allows investors to make informed decisions based on accurate, publicly reviewed information. Offer timing, pricing and disclosures. Timing, pricing and disclosures are critical components of any public offer. For issues over $50 million, the offer must be made within 12 months from the date of observations by the authority. For smaller issues, the countdown begins from the date of receiving the offer document. The pricing can be determined either through a fixed price mechanism, or a book building process, depending on market conditions. This pricing strategy, along with other key disclosures, must be clearly outlined in the offer document. Required disclosures include offer summary and risk factors, financial condition and capital structure, objectives of the issue, business and management information, legal information, audited financial statements from the last 3 years. It's essential that all financial statements provided are no older than 135 days to ensure accuracy. Minimum subscription, anchor investors, and key conditions. A public offer is only successful if it reaches the minimum subscription disclosed in the offer document. This applies to fresh issues of securities, not offer for sale. Additionally, issuers may offer a portion of the issue to anchor investors, often large institutional investors, who agree to invest before the offer opens to the public. The issuer may also appoint a monitoring agency to track the use of proceeds from the issue. Details about underwriting arrangements must be disclosed in the offer documents to ensure transparency. Fast-track FPO and post-issue compliance. Did you know that issuers can conduct fast-track FPOs if they meet specific criteria? These criteria include being listed for at least 18 months, complying with regulatory requirements, having no adverse regulatory opinions or ongoing legal investigations. If the issuer doesn't meet these requirements, it must follow the same procedure as for an IPO. Once the issue is complete, a post-issue report must be submitted detailing subscription levels, allotments, and refunds to the stock exchange.